Welcome to the Investors Trading Academy event of the week. Each week, our staff of analysts and educators tries to provide you a better understanding of a major market event scheduled soon and that have an effect on the global markets. The two most influential central banks will be meeting late in October. The Federal Reserve meeting in October is usually a minor event, but this year it holds a lot more importance as the Fed is expected to raise rates in 2015, and this leaves only their October and December meetings. We have covered the FOMC events in several other videos, and in this video we are going to look at the European Central Bank meeting which precedes the Federal Reserve event. The ECB will meet on October 22nd and will release their decision and statement at 12:45 GMT, and then it will be followed by a press conference by Mario Draghi at 13:30 GMT. The fireworks are usually in the words and comments made during the question and answer portion of Mr. Draghi's press conference. Economic data has been disappointing of late, and markets will be eagerly speculating on the outcome of Draghi's statement post-meeting. Reading the summary of the points discussed last month by the ECB, one would likely conclude that QE could be indeed extended, although this might not come as soon as this month, barring a worsening of financial conditions. To make the discussion more specific, here are some highlights from the last meeting. The bank highlighted the excess liquidity and has been building steadily, which is to say that the amount of cash stored by European leaders with ECB has increased in one single month by €100 billion to €499 billion. Meanwhile, the loan dynamics remain weak overall, although many argue that the bank-dependent European economy cannot grow sustainably without a strengthening in corporate loans growth. What is more, since the ECB has published enhanced statistics on loans to the euro area private sectors, which basically resulted in downward revisions. Since March, the European Central Bank has been pumping €60 billion a month into the economy as part of its battle to drive up inflationary pressures, but the programme has so far failed to spark price rises. Expectations are that it will eventually have to be extended beyond its planned completion date. New stimulus is likely to reflect the ECB's heightening risk aversion, increasing awareness by Governing Council that the bank's inflation projects are too optimistic, and the need to counter upward pressure on the euro. But with the ECB's next rate meeting fast approaching, most bets have already been made that the hawks seem to be winning, so there may not be any extension of expansion of quantitative easing for now. Next week, some of the ECB's biggest guns are speaking, so if their thinking is shifting, it'll be the time to send fresh signals before the October 22nd gathering of rate setters in Malta. In contrast, other major central banks long ago set the printing presses running to flood their economies with newly created money, spending around $7 trillion to defend themselves during the global financial crisis.